don't jump to the wrong conclusion that this is the end for gold, or gold's not going to be a safe haven, or gold's not going to go up. Gold is going up. The war is very bullish for gold because the war is going to be very inflationary, and ultimately it's going to lead to a much lower dollar, and that is going to be bullish for gold. But for now, you've just got another opportunity to keep buying gold, to keep buying silver. Silver's about $85.50. Again, we're nowhere near 50. We broke out. We're just consolidating, and silver has been as high at 120 or something like that, just like oil, almost the same price that oil got to. And both oil and silver are going to make new highs.
Bank of America's head of metals research, Michael Widmer, just came out and said silver could reach anywhere between 135 and 309 this year. And you look at the COMEX market, that's again under delivery pressure. The last thing that this administration wants is to see gold and silver going to the moon and the dollar collapsing. And so it doesn't take very much to massage that, if you will, in what is a very tense situation that seems to be getting a little bit more out of control.
The precious metals market is currently signaling a massive buying opportunity, despite misconceptions that the recent surge in gold has peaked. Ongoing geopolitical conflicts are inherently inflationary and are practically guaranteed to drive the US dollar much lower, creating an incredibly bullish macroeconomic environment for both gold and silver, while silver is healthily consolidating around the $85.50 mark after its recent breakout. This temporary pause is absolutely not the end of its run. Historically, silver has surged alongside oil, previously pushing toward the $120 mark, and both commodities are perfectly positioned to establish unprecedented new market highs. Major financial institutions are taking notice. Bank of America's head of metals research, Michael Widmer, recently projected that silver could skyrocket anywhere between $135 and $309 this year. Concurrently, the COMEX market is experiencing severe physical delivery pressure. Despite obvious motives from central authorities to carefully massage or suppress these prices to prevent a visible dollar collapse during tense global situations, the fundamental supply mechanics cannot be contained forever. This underlying physical drain practically ensures that accumulating tangible assets during these brief consolidation phases is a vital strategy for wealth preservation before the next explosive breakout. Providing these urgent market insights are Peter Schiff and Andy Schectman, two highly respected voices in macroeconomic analysis and the physical bullion industry. Together, these seasoned experts specialize in decoding complex monetary policies, inflationary trends, and global supply deficits to help everyday investors secure their portfolios with tangible hard assets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Don't forget about buying some gold and silver at Schiff Gold. Let me take a look and see if we've had any kind of reversal, because the market was down. Yeah, gold's down about 23 bucks, 51.51. Silver is down about 37 cents, 85 and a quarter. Oil prices, what are they doing? They're about the same, about $93 a barrel for oil. But get your gold and silver while you can. Another big leg up is coming, and an even bigger opportunity exists in these mining stocks. EPGIX is my fund, and I think we've got a great portfolio of stocks, particularly the juniors, that I think are really going to explode to the upside in the next leg of this bull market. You can get all the information on my funds, all 5 of my funds. You can read the prospectuses. The biggest losers in the stock market so far from this Iran war have been the gold stocks, gold and silver mining stocks. Even though gold and silver prices haven't really come down, all that happened is they didn't go up. Gold and silver prices are about where they were, but the mining stocks have got hit pretty hard, way harder than the Dow or the NASDAQ or, any of those. Now, of course, gold and silver stocks went up a lot more. In fact, the market was, flat. The gold stocks were way up in 2026 after having killed it in 2025. So they're losing some of those gains as people are taking profits or selling stuff, and they're getting nervous about the war, about recession. Maybe the Fed is not going to cut rates because of the high oil prices or whatever. But this has created another great buying opportunity in the mining stocks, because they were a great buy before this decline, and now they're an even better buy because their profits are not declining. Now, yes, oil prices have gone up, And that is going to be a factor in the profits of gold and silver mining companies. But even with the higher oil costs, it's still not going to offset the profits from higher gold and silver prices. And those higher profits were still not reflected in the stock prices. So you could say that some of the benefit has been reduced by the by the increase in oil prices. But again, if the market thinks this is just temporary, which it obviously does, because if they thought it was permanent, there would be a much bigger drop in the S&P and the NASDAQ, and there would be a much bigger rise in oil stocks. I mean, oil companies have gone up. My oil stocks are doing well. They're making new multi-year highs. And I talked about how I added to our oil positions, and I added to my own oil positions a few months ago, anticipating higher oil prices, not necessarily because of a war, although I knew that was possible, but I thought oil prices were going to go up, and I was right about that. The market just assumes that oil price spike is a short-term phenomenon, so it's not going to impact earnings according to the way the market views it. So they should be looking at these gold and silver mining stocks as incredible buys, which they are. And I think they're going to rally big any day. It's hard to say when they're going to flush out the weak sellers, but that's going to happen. And gold and silver are going to rise, and these stocks are going to make new highs. And I think you want to take advantage. So not only do you want to go to Schiff Gold and buy physical gold and silver now, but you want to buy the mining stocks, whether you pick your own mining stocks or open up an account at Euro Pacific Asset Management for us to manage for you, or you buy my gold fund, right? Buy my fund at Euro Pacific Asset Management. My fund is EPGIX. That's the no-load advisors class that you could buy at any discount broker. Or if you want to do it yourself, you could, subscribe to our newsletter, Strategic Assets. We've got interesting companies that we profile in this space that you could just go out and buy. These are a lot of smaller stocks that are even too small in many cases for us to buy in the funds. This is an opportunity in these stocks. I think the overall stock market hasn't gone down enough, but gold hasn't gone up enough. It hasn't even gone up at all, and these gold and silver mining stocks should not have gone down, yet they did, and that just represents another great opportunity to buy them. We've seen some strength in the dollar, not a lot of strength, but we had seen some strength in the dollar. And I think that's one of the reasons that we haven't seen a big run-up in gold. I mean, gold prices are still around 5,150. So gold hasn't really rallied during this. Now, of course, gold had a huge rally before the Iran war broke out. So it's just kind of consolidating. Don't jump to the wrong conclusion that this is the end for gold, or gold's not going to be a safe haven, or gold's not going to go up. Gold is going up. The war is very bullish for gold because the war is going to be very inflationary, and ultimately it's going to lead to a much lower dollar. And that is going to be bullish for gold. But for now, you've just got another opportunity to keep buying gold, to keep buying silver. Silver's about $85.50. Again, we're nowhere near 50. We broke out. We're just consolidating. And silver has been as high as 120 or something like that, just like oil, almost the same price that oil got to. And both oil and silver are going to make new highs. They're going to make considerable new highs. So you have an opportunity to buy them now.
The recent dip in the precious metals market presents an exceptional buying opportunity for astute investors. While physical gold and silver experienced a minor pullback, the most significant mispricing is currently found within mining equities. These stocks have faced unwarranted sell-offs driven by fleeting fears of a recession and rising energy costs associated with ongoing global conflicts. Although oil prices have stabilized around $93 a barrel, these marginally increased operational expenses will not offset the massive profit margins generated by historically elevated metal prices. The broader market is incorrectly pricing in this energy inflation as a temporary phenomenon, while entirely ignoring the robust financial fundamentals of the mining sector. As the underlying monetary metals prepare for their next major upward trajectory, these deeply undervalued mining stocks are perfectly positioned for a substantial market rally. Securing these equities during this brief consolidation phase is a highly strategic move. Let's get back to the interview.
Well, you got the Bank of America's head of metals research, Michael Widmer, just came out and said silver could reach anywhere between 135 and 309 this year. And you look at the COMEX market, that's again under delivery pressure. The registered stocks right now in COMEX for the month of March are 81 million ounces, and that's roughly 16 million contracts. And it's standing against open interest of 112,000 contracts. They've already delivered 6,615 contracts. That's 33,075,000 ounces. And this does not prove any failure, but it does show a much thinner registered cushion than headline open interest might suggest. Shocking. And so when we see in the month of February, 38 million ounces leave COMEX and only 25 million or so ounces delivered, 160% of what deliveries could explain left. And so you're seeing big money that is using price and the subdued price, the suppressed price to stand for delivery, and it has not stopped. And, nowhere do we see more blatant manipulation than in the silver market, where 4 instances since Thanksgiving have centered on the tiny little market that is silver on the COMEX, and their servers overheating or glitches on the circuit breakers or just outright glitch. And, it just shows the desperation. At the same time, the registered stocks are dwindling on COMEX. You see the same problem in London. You see the same problem in Shanghai. And it's getting to a point where paper promises are really going to come headlong into delivery demand. That is how all of this changes. Most of us never thought it would ever change, but it's actually being challenged across the board, not just by the central banks, but some very sophisticated traders here in the United States that continue every single month to stand for delivery. And we watch the metal leave, and then we have to ask ourselves, do you think it's a coincidence that they made it strategic? Do you think it's a coincidence that Project Vault just showed up and the state-sponsored price floor underneath it to incentivize mining? None of this is a coincidence. And I would say, as far as silver is concerned, it's still the value of a generation. And yes, it's been managed lower, but they can't keep it lower when there's this much physical demand and outflows that are betraying their ability to kind of tell us what the price should be based upon their own metric. I've been talking about a lot last week, 38 million ounces of silver left COMEX. Where did it go? You're talking an armada of trucks. A mint box of Silver Eagles weighs 42 pounds. That's 500 ounces. Who's taking possession of 39 million ounces, nearly 38 point whatever million, almost 39, and where's it going? Who's insuring it, running logistics? And the same thing would be true with gold, where we've seen, anywhere from 3 to 8 or 9 million ounces every month for 16 months get delivered. Where's it going? Some stays in COMEX, some leaves COMEX. And, just because it stays in COMEX, it doesn't really mean that it's going to ever get back into the registered category. When it comes onto COMEX, it can be held in a Brinks facility, which is a COMEX facility, or any of the other COMEX facilities, in what's called eligible. It's not for sale, while they figure out what to do with it. But we are seeing more and more metal leave the COMEX ecosystem, which is an indictment, because once it's loaded on those trucks and palleted out, there is a very labor-intensive and costly process to put it back in to COMEX. It would have to be reassayed and reintroduced into the ecosystem. Very, very, very time-consuming and costly. So if it is leaving, they have no intentions, whoever they are, of ever sending it. I think this is largely done other ways and would be with futures contracts. And it's really not that hard to do, as we've seen for all of these years. And again, it's not really down. It's just kind of in a trading range, which is a lot easier to do. But, it just seems that every time it's about to get steam, something happens. A glitch to the upside or circuit breakers to the downside. And, 4 glitches since Thanksgiving should make someone wonder what the hell's going on. Who would have ever been able to guess what would happen in Afghanistan or in Iraq, that these things have a way of turning very ugly? I don't know what's going to happen. I hope for the best, of course. But what I see happening is a drawn out war that costs more and more and more money, adds to the deficit, adds to the spending, adds to the debt issuance, adds to the probability that the Federal Reserve has to come in and monetize debt. And this is not a good situation, Michelle. It's not a good situation at all. And it's certainly good for gold and silver. That's about the only thing it's good for, in my opinion. It just, to me, it's not going to be what it was promised to be, a 4-day war. It's going to be a whole lot longer than that. And I think that's not good. Not good for the kids that are fighting, not good for the image of this country, not good for the dollar, our indebtedness, our everything. And as the price of oil goes up, it acts as a massive tax on everyone out there who's already struggling to make ends meet. It's always been managed on COMEX and using the ETFs. I'll give you an example, kind of what I mean by that. We saw $4.2 billion worth of gold leave GLD last in a week at prices near all-time highs. Now, GLD is in many ways a proxy for the appetite for gold, and at least by the mainstream. And it just recorded its single largest weekly outflow in its 20-year history and broadcast all over the news that gold had topped, and same kind of light that you're saying. Why hasn't it taken off in the face of this war? And we just saw its biggest single outflow ever, but I don't look at it that way. In fact, the price would have collapsed if that were the case. It seems to me that someone is selling the ETF and someone else is taking delivery of the metal. What I mean by that is it seems like to me, GLD is acting as a deliverable reservoir. In other words, the big commercial banks, in particular, Goldman and Citi, the authorized participants, they are able to create and redeem baskets, as they're called, of metal. And those baskets are 100,000 shares each. And the trust process actually allows these authorized participants the ability to create and redeem through the trust. And so in essence, what they are really doing, in my mind, is that this large outflow, it to me is mechanically the same thing as the authorized participants handing shares to the trust and receiving gold back. And it's a way for them to do so without going on to the COMEX market and screaming about the shortage and standing for delivery and taking possession when it becomes very obvious. This is something that they're allowed to do, and it is much more opaque and it is much more difficult to ascertain. And it's framed by the mainstream as people are selling GLD. It's not. It's share redemption by the big banks that want to take possession of them. That's correct. And to me, the media interpretation is that nobody wants gold, but I think it's the opposite of that. Rather, it's someone wants bars more than they want ETF exposure. And I think that's exactly what is happening, because when you see that kind of outflow and prices stay stable, you said it's down 1%. Okay, big deal. It's back up 1% today, or nearly. So the point of it is that, the price would collapse if there was that kind of outflow, but there's not. It's not an outflow. It's just a redeeming of the shares. And as far as I'm concerned, it says a lot more about the state of the market, where there is a rush, and to do so quietly without causing too much stir or attention to hold and acquire the real thing. And we're seeing it in places like that. But this has been a managed market for a very long time. The last thing that this administration wants is to see gold and silver going to the moon and the dollar collapsing. And so it doesn't take very much to massage that, if you will, in what is a very tense situation that seems to be getting a little bit more out of control, certainly different than the 4 days we were told or promised it would be.
In conclusion, the undeniable physical drain on global precious metals exchanges signals a historic paradigm shift. The traditional paper markets are rapidly colliding with physical reality as major institutions like the COMEX, London, and Shanghai face unprecedented delivery pressure. Currently, open interest contracts severely outnumber available registered silver, exposing the fragile illusion of the derivative pricing model. This extreme vulnerability is further highlighted by recent data revealing that 38 million ounces of silver were completely removed from the COMEX ecosystem in a single month, requiring a literal armada of trucks to transport. Once this metal permanently leaves the vault, the expensive and time-consuming reassaying process virtually guarantees it will never return to the registered supply. Furthermore, the blatant artificial suppression of these markets is definitively failing. Repeated exchange glitches and circuit breaker anomalies act as desperate attempts to mask the inevitable price explosion. Sophisticated domestic traders and global central banks are actively exploiting these suppressed valuations to aggressively accumulate tangible bullion. As drawn-out geopolitical conflicts continuously force the Federal Reserve to monetize massive deficits, fiat currencies will drastically weaken, but must follow this fundamental truth. Securing hard assets like gold and silver is the definitive strategy for preserving your wealth. Share your thoughts in comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.